Welcome, everyone, to Great Investments Special Report. Today, we're going to talk about tariffs and market volatility. Yesterday afternoon, on April 2nd, President Trump announced the latest round of tariffs. And today, we'll discuss what the actual announcements were, their implications, what we need to do, if anything, with our portfolios. So let's get started. Now, the first thing that caught the market by surprise, and again, if you're watching the markets, the S&P 500 this morning was down by about over 4%. And the reason the markets were down so aggressively is because Trump introduced a 10% import tariff on all goods coming into the U.S., which is a bit of a surprise. Everybody's expecting reciprocal trade tariffs to get announced, and he did announce that. But in addition to that, he announced a 10% across the board. The other thing that's got the markets a little bit worried is how quickly these tariffs are going to go into place. The 10% across the board is going to go in place on April 5th, just a few days away. And the actual reciprocal tariffs are going to go in place on April 9th. So that's a pretty quick turnaround. Now, you can see in this chart here as well is China, for example, their tariff rate is going to be 34%. And that's just on top of the 20% not too long ago. So in total, the tariffs on imports from China are going to be up 54%. Europe as a whole is going to be up 20%. So these are pretty aggressive level of tariffs. And the reason we get a lot of questions from advisors why the tariffs is Trump feels that the U.S. has been treated unfairly the last several years and decades on our trade policy. We actually consume about 30% of the world's goods. We only produce about 15%, so we have a trade imbalance. Whereas other countries like in Europe, they're producing about 13% and consume about 13%. Now, China is where the real sticking point is. China exports about 32% of the world's goods, but only consumes about 12%. So there's a big imbalance between what the U.S. consumers consume and what we export and what China exports and what they consume as well. And Trump's trying to level the playing field. So that's what is at the heart of the trade tariff issue for Trump. Now let's talk about the implications and why the market's so fearful with this latest round. Again, 10% was a surprise across the board. And with tariffs are considered a tax. And with taxes, somebody has to pay. And the three parties that could possibly pay are the exporter, the person making the goods, the importer, that's when the actual tariff gets paid, or it gets passed on to the consumer. So one of the three parties will end up having a tax on the goods that either making or consuming. So again, in general, when you hear taxes, that's not a good thing. So, and also we have to worry about how is this going to impact our overall economy. With some smaller tariffs, it wasn't that big a deal, but as you start layering on these tariffs as a whole, this could certainly impact the overall economy, corporate earnings, consumer spend, which consumer spends are about 70% that drives the U.S. GDP. So if they have a tax on it, they potentially could send a little bit less, which would be negative for the overall market as well. And the other thing about these tariffs, markets don't like uncertainty. And these tariffs are a moving target. We certainly didn't know exactly what the tariff announcements were going to come out until last night. Now we know they are. They're actually a little bit more difficult than what most investors expected. So again, these are moving targets. Now, will they be here in 2, 3, 4, 6 months? We're not sure. We think this could potentially be the high point of where the tariffs are, but we're not sure right now. So, and again, Trump's going to keep these in place until he is satisfied they've been resolved and mitigated. So basically, he wants that trade imbalance to normalize. We want to get closer to what we're consuming as what we're exporting as well. So now let's talk about the actual implications for our trade partners. Our biggest three trade partners are Canada, Mexico, and China. Those three combined are about 43% of our overall inputs. That's very significant. And if you look on the chart here on the left-hand side, like I mentioned earlier, China is going to have a now 54% import tariff on all the goods coming into the U.S. So that's going to make things potentially more expensive for the consumer, less profitable for the importer, or less profitable for the exporter. Again, tariffs are a tax, and that's a pretty big, hefty tax. Anything that's imported from China is going to have a 54% import tax on it. And so if you add up all of our top 15 trade partners, the weighted average tariff is going to be about 26%. That's a pretty steep number. Again, that tariff or tax is going to have to be on the shoulders of either the exporter, the importer, or the consumer. So again, the ultimate end game is Trump wants more of a trade balance. Now, what do we want to do with our portfolios and our individual investments? Well, certainly tariffs are causing uncertainty and markets don't like uncertainty, but we don't feel that's going to go anyway anytime soon. We think we may have hit the worst point with the announcements yesterday, the pretty aggressive 10% across the boards. And as long as there's not a trade war or a tariff war where every country keeps ratcheting up, we think this could be the high point. And if we go to the back half of the year, some of these tariffs that are in place now or yet announced, they may not actually be in place by the end of the year. So that's what the market's trying to determine right now. How long are these going to be in place and what impact they're going to actually have on the bottom line, or certainly in the company's line and the consumer's pocketbook. The other thing we recommend is do not trade headlines. These headlines will come and go. And again, with tariffs, I would expect more of this volatility for the next several months until we start seeing some negotiations on the other side and some of the tariffs actually get repealed. The other thing for your overall plan, working with your advisors, stay diversified. You're not only going to be in the stock market, you'll have some bond exposure, some FIAs. The other things you may have is buffer strategies as well. They help protect on the downside. Remember, stick to your long-term investment plan. Working with your advisor, this is a kind of a blip in the road. Markets over time tend to work themselves higher. So this is an opportunity, maybe if you were underweight risk, to add a little bit of risk. Now, if you had a little bit too much risk exposure, maybe you have to reassess and dial your risk level back a little bit. We think the markets are going to kind of bounce around here, and over time, they'll continue to grind higher. Hopefully this is helpful. Thank you for listening.